if you can build leverage in litigation, that's going to improve your chances of getting a meaningful modification. And finally, one of the ways to keep your home is the statute of limitations. We'll talk a little bit more about all the problems these banks are having with their paperwork and bringing these foreclosures. And there's been a bunch of moratoriums that have been issued, and I have several clients who have now gone several years without making a payment on their mortgage, and some haven't even been sued yet. And in Florida, there's a statute of limitations of 5 years. 5 years from the date of your default. So if you made your payment May 1st of 2006, and that was your last payment, and now it's May 1st of 2011, and nobody has sued you, or you've been sued by the wrong party, which has happened over and over and over again. We're seeing much more of this. Once that 5-year statute of limitations has run, that debt is unenforceable. The lien against your home is unenforceable. And that is going to be, it's still a little early to get there, but that is where I expect to see some people getting to keep their home for free, if that's ever going to happen. Now, as I said, the safest thing to do here, and for those people who recognize there are dangers of going into foreclosure, safest thing to do is just to give the bank what they want. Either pay them what you owe them, reinstate for the full amount, make the payoff. Don't fight about the fees and charges and attorney's fees. You can sometimes negotiate those, but they're going to be very tough with you when they have a choice of either letting you keep paying or reducing some of their fees. And we'll talk more about why the fees are such an issue. But that's certainly the safest way to avoid any kind of issues, is just to pay. Now, you can ask for help nicely, and that's been the process that's been in place for several years now. What I can say is that the banks want you to, the way they have this set up is, they want you to come in and they want you to give them all your documents, all of your financial information, a financial roadmap to everything that you own and that you have an interest in. And they're usually looking for copies of bank statements for 2 months, W-2s, tax returns, profit and loss statements if you're self-employed. They want to see a hardship letter. They want to have all this information given to them so that they can then tell you whether or not they think you qualify for a modification. And what I've seen now over the past few years is this process has been not just an abject failure, but an utter nightmare. The banks are not set up for this. They do not have. They've never had the resources to deal with this. The number of people who are in trouble now, and the problem has been that rather than acknowledge that they're behind and they're having issues, they put it back on the borrowers, and they say, you didn't give us this document, even though you've already sent it to them 3 times. Or they tell you that they lost the paperwork and they need you to resubmit it. Or more often what they say is that the paperwork expired. They need you to update it. The process has been a nightmare. My firm has never sat on hold waiting to talk to loss mitigation. That's not the way that we choose to do this. And I think that was a smart decision we made several years ago. It just does not help, I think, to ask the bank nicely. Because what's been happening is, the modifications that they're offering, it's based on a false premise. The whole entire HAMP modification process, Obama's Home Affordable Mortgage Program, which is intended to be the flagship, savior of all of these people who are having trouble with their mortgages, is based on the premise that if we give you a modification now that reduces your payments for the next 5 years, and it gradually increases you back to your original payment in 5 years, property values will be back by then, and you'll be in a much better place. I think we can all make our own decisions about whether we think property values are going back to where they need to be within the next 5 years, and recognize this program's been going on for 3 years, and I haven't seen any evidence that the property values are going back up. One of the biggest problems we're seeing with the HAMP modifications is we're just not seeing principal balance reductions. I mean, it's possible for the banks to do them, but they're very few and far between. And when they are done, they're not necessarily meaningful balance reductions. I mean, if you're now upside down by only 125,000 instead of 150,000, I don't know if that changes your decision so many times. But one of the things that we've been learning about here is like what's happening behind the scenes. Like why is the modification process proving to be such a failure? Well, I think what you're going to see if you haven't gone through the process already is that the servicers are not really trying to get the job done. They are not your friends. They are not there to try to help you. They are there to process your paperwork and comply with it, whatever obligations and policies the servicers need to comply with in order to appear to be voluntarily complying with whatever these programs are expecting of them. But the truth is that the process is not set up to be successful. And that has borne itself out in the overwhelming number of people who have walked away after making payments for a year under temporary modification plans, only to be told, sorry, you can't. We're going to have to foreclose on you unless you can pay us all the money back for the last year's worth of payments that you weren't making the full amount. So what we believe is that the reason why we're seeing so few modifications is because the servicers make less money if there's a modification done. Now, let's talk about how it used to be back in the day when my dad took out his mortgage. What happened was he went to the bank and gave the bank all his financial information. And when the bank took his financial information, they actually called and confirmed and went through and made sure that what he was saying was true, and they gave him a loan. And over the next 30 years, the purpose of the payments were made and the money was paid back, and my dad got a satisfaction mortgage from the same exact bank he started with. And that was overwhelmingly how it was done. And if you ran into problems, the bank would deal with you directly. You were their customer, and they would and they were in business long enough to know that sometimes people had problems, and they would work them out. But now we have a whole new process. It's called securitization. And we'll talk a little bit more about this in the future. But you'll see that there's a blue box, and that's the borrower. And there's a whole lot of other boxes around the borrower that are all involved in dealing with this issue. And what happens is that there's the investor all the way down at the bottom, and they are pretty far removed from everything except for final decisions and money that's all going to flow to them. The money goes from the borrower to the servicer, and the servicer then forwards those monies up to the master servicer, who's also the issuer, and then it goes up to the investors, and they get paid. Now, the servicer is not the investor. The servicer is the company that's hired by the investor to act as that liaison, as that go-between. And the question, I've gotten a couple of questions from one of you who's asked me about, is it possible to only pay the principal if you want to pay off a loan, or will the bank always add the fees and charges? Well, the fees and charges are primarily the servicer's fees and charges, and what I can say is anything's possible, but it depends on your lender, and most lenders, if you are paying them off in full and there's no litigation going on, that you have to deal with the fact that all they have to do is say no. You have to pay all the money. And then you're in a position of, do you pay it under protest and try to sue them afterwards, or do you just not pay them? Because they're not going to release their lien if you make a payment of just the principal when they claim more money is owed. Now another question I've gotten is, what about just working on a loan modification to show good faith? I do recommend trying the process, There are all kinds of defenses that we'll talk about later that are being raised now for banks that are abusing the loss mitigation process and or not doing the things that they're supposed to do during the loss mitigation process. And ultimately, a lot of the issues that are come up in court, if we ever got that far to go to an actual trial, showing good faith and showing that, to a judge that you tried to work this thing out will be meaningful. There will be a value to that. But you got to recognize that there's also going to be stress and frustration in trying to do that loan modification process. Now, we talked before about that servicer, and I believe that the biggest problem that we're seeing with these modifications is that the servicer is the one that's supposed to be doing them. And let's look at the financial structure that these servicers are set up at. The way servicers get paid is they get paid what's basically called 25 basis points of a mortgage. So it's a quarter of 1% of the principal balance is what is a basis point. And what that means is basically if they're servicing a $500,000 loan and they collect all the payments for the year and they send out all the notices and do whatever has to be done and the loan's performing just fine, the servicer gets about $104 for the year for their fees for that loan. But once a servicer is dealing with a client that stops paying, that's when they start making their money. They get to keep all the late fees, and you'll see late fees sometimes of quite a lot of money is what they're charging. It's not just a $15 late fee; it's a percentage of the amount of the payment that goes to the servicer. If you ask them for a payoff quote, they'll put in a payoff quote preparation fee. If you send them faxes, they'll charge a fax fee. If they get to charge you force-placed insurance, they'll get to pay that, take that back. If they pay your taxes, they can collect that money back. Property inspections and broker price opinions are one of the things that we believe is a huge, I wouldn't say a scam, but it ain't really appropriate what I see. I just had a trial this past week where the bank, basically collected another $364 by charging $12 a month for them to do what they called a property inspection, which is supposedly sending someone out in a car to drive by the house and make sure it's still there. And I think at the end of the day, it's just an effort. If they do that on every loan and they get an extra $300, they're going to make a lot more money that way. Broker price opinions is another thing they do. If they need to know what the value of the place is today, they hire a realtor and they pay him sometimes $500, $600, $800. All of that goes on to the fees that the servicer can collect. And the servicer's creed is pay yourself first. What the servicer knows is that as soon as you reinstate your loan or you liquidate the loan, either by paying it off or doing a short sale, or they foreclose and sell the property back on the regular market, whenever those funds come in, the first fees that get paid are the servicer's fees. All those different fees we just talked about. And that is, I believe, why you see servicers not so interested in working out modifications where they're going to have to waive all those fees and let people get back into paying their loan and getting their 25 basis points as a fee anymore. So we talked a lot about loan modifications, and there's different ones that are out there, and I think you should know about them. First off,